Alexis Zamore, and tonight we're bringing you a special report on a crisis that's no longer just hitting headlines. It's hitting home. Housing affordability isn't just an economic problem, it's a growing risk for insurers. As tenant displacement, community destabilization, and rising property costs reshape neighborhoods, traditional underwriting models fall short. In today's segment, we explore how the insurance industry can rethink social risk, starting with new models of coverage, fresh public-private approaches, and evolving underwriting strategies. Those topics and why they matter, coming to you next, right here on IMGT TV. When rents rise faster than wages, when home ownership slips away, the fallout is more than displacement. Communities start to unravel. Turnover goes up, maintenance goes down, crime can start to creep in, and the bonds that hold neighborhoods together, trust, familiarity, shared investment, begin to fray. For insurers, that erosion is measurable. Loss ratios climb, and claims become less predictable. Vacant buildings attract vandalism, arson, and liability hazards, and the models insurers rely on, calibrated to decades of stable patterns, can't keep pace with the volatility housing instability creates. It's the same for investors and landlords. Tenant retention drops, default risk rises, and compliance with new affordability regulations adds another layer of pressure. For policymakers, the change is relentless. Respond to housing scarcity with limited budgets and fragmented partnerships while trying to keep communities stable? This isn't just a humanitarian problem. It's a systematic one. And it's costing all of us more than we think. Some of the most promising answers aren't coming from state capitals or corporate boardrooms. They're coming from the streets, the neighborhoods, and the people living in the middle of it. This is where we found one of the most intriguing ideas: community-led risk sharing. The premise is simple, but the implications are powerful. Instead of relying only on traditional insurers or slow-moving government programs, communities like this suburban Atlanta neighborhood are pooling their own resources to protect themselves. And in the process, they're keeping capital and control right here at home. Here's how it works. Residents, local businesses, or tenant cooperatives form a mutual risk pool or a captive insurance entity. Everyone chips in modest premiums to a shared fund. Over time, reserves build up, and when disaster strikes, say a fire, flood, or even a sudden spike in rent, the fund can step in quickly without red tape. Because members are both the insurers and the insured, overhead stays low, and when there's money left over, it goes back into the community, funding roof repairs, flood barriers, or local scholarships. Insurance becomes not just a cost, but an investment in resilience. And this isn't hypothetical. In British Columbia, affordable housing providers have already built similar pools, leveraging their collective bargaining power to lower premiums, stabilize budgets, and reinvest savings into building upkeep. It's proof that even in a high-cost market, communities can take some of the risk back into their own hands. And it doesn't stop at traditional coverage. These groups are experimenting with something called parametric insurance as well. Coverage that triggers automatically when a set condition is met. For example, if median rent in a zip code jumps more than a certain percentage in a year, the fund instantly pays out to help renters absorb the shock. No claims adjusters, no waiting for a decision, just targeted relief exactly when it's needed. Of course, the money matters, but what matters more is the governance. These funds are run by boards made up of renters, homeowners, and small business owners, people with a stake in this neighborhood. Decisions are transparent, trust builds, and even when payouts don't quite match every loss perfectly, the investments in local infrastructure leave everyone better off. Community-led risk sharing won't solve the housing crisis alone, but it's a blueprint for how local initiative, financial creativity, and shared responsibility can turn vulnerability into resilience. Now, we'll hit the streets of New York with my colleague Rachel to discuss how public-private partnerships are scaling ideas like this one, aligning the interests of landlords, tenants, insurers, and governments. Over to you, Rachel.
Thanks, Alexis. This is Rachel Day, and I'm joining you live from New York City, where you may find it impossible not to overhear residents voicing their concerns about the cost of housing. From renters to aspiring owners, the conversation about housing affordability is both timely and urgent. Today, I'm covering what could happen when governments and the private sector team up to take this challenge head on together. Addressing the layered societal issue of housing affordability requires collaborative solutions. So, how can tenants, landlords, insurers, investors, and governments work together? Public private partnerships. Done right, they can align insurance markets with social resilience, using financial innovation to keep people in their homes and communities intact. The reality is, landlords and tenants both experience financial distress, but for very different reasons. And most solutions out there just help one side at the expense of the other. But public private partnerships can break that by intervening with solutions where helping one side naturally benefits the other. Let's start with landlords. For a commercial multifamily property, insurance is a major expense. Here in New York City, insuring just one affordable apartment unit now costs about $1,700 a year. That's more than double what it was just 4 years ago. Property insurance premiums have risen across the country due to climate risk and inflation. Liability coverage is now emerging as the next major challenge, especially for properties with heavy foot traffic or high occupancy. But what if landlords who commit to rent affordability and property upkeep could get a premium credit from insurers subsidized by the government? Their commitment in terms of promoting affordability could consist of offering multi year leases, capping rent increases, or designating a portion of units as affordable based on neighborhood median income. And compliance to property upkeep requirements could be verified through inspections, tenant surveys, or even a maintenance app. On the tenant side, public private partnerships could look like an insurance voucher program, similar to housing vouchers, but for renters and small businesses insurance. This could operate on a sliding scale based on income, neighborhood, and cost of living changes. Why include small businesses? Because they maintain the culture of the existing residential community and they're the backbone of the economy. Local businesses create local jobs, and when that local money is spent locally, it tends to stay in the community. In fact, it's reinvested between 3 and 6 more times in the same community. This voucher wouldn't solve rising costs of rent overnight, but it would alleviate some of the financial burden to preserve lifelong residents and businesses within the community. Public private partnerships can also encourage experimental insurance models through innovative financing, assuming risk, and regulatory changes. Think about tailored group coverage like USAA for military residents, but for affordable housing co op owners. In New York, the Housing Development Fund Corporation has over 1,000 co ops, often requiring strict maximum income requirements to serve low and middle income earners. Public private partnerships could create a bespoke insurance product for those co op residents, where their unique needs would be factored into coverages. The government could help subsidize premiums or deductibles, and insurers could offer complementary services like inspections and assessments to help manage risk. Then there's the financing side, which is where social bonds come in. Remember earlier, we discussed reasons behind the lack of property maintenance, repair, and renovation. Well, it's estimated that there are over 900,000 vacant units in New York City, about a quarter of which are likely to be warehoused or uninhabitable. Here's how public private partnerships could help get these vacant units back on the market. First, landlords and agencies would register their vacant unit or building in need of rehabilitation. Second, the government would issue a bond to raise capital for the cost of improvements. And lastly, impact investors provide both funding and advisory with repayment tied to the number of units restored and rented affordably. The result? More affordable housing options that also offer healthier living conditions and improved community stability. Landlords are back in a position where they can rent their space without operating at a loss, and they wouldn't need to hike up rents. The government is improving the well being of their constituents and the local economy, and impact investors receive a payout at the agreed outcome. So, as we've discussed, you now see that public private partnerships can transform housing by sharing the risk and sharing the reward. They can incentivize anti displacement with premium relief programs, foster experimental insurance models, and broaden the use of traditional risk transfer tools. Together, stakeholders collaborate on creating solutions to address the affordability crisis, which is in everyone's interest. Up next, we will explore the possibilities of underwriting social infrastructure and cohesion. Over to you, Brianna.
Thanks, Rachel. When you think about underwriting, you probably picture numbers, property details, and historical loss data. But what if we could go beyond the usual risk factors and start considering the strength of the community itself? Could social infrastructure and property stewardship actually reduce risk over time? For generations, insurance companies have relied on hard data like fire risks, flood zones, and past claims. But these data points often miss something that insurers say they deeply care about: risk mitigation. And when it comes to long-term property portfolios, one of the most overlooked risk reducers might not be a building feature, but a social one. For years, research has shown that social cohesion, meaning how connected residents are to their neighborhoods and communities, correlates with faster disaster recovery, reduced vandalism, and even better preventative care. Yet this remains invisible in most underwriting frameworks. The suggestion isn't that actuaries overhaul their models tomorrow, but the industry does need to start somewhere, and that somewhere is the underwriting desk. Insurers can begin experimenting, piloting programs that test indicators like average length of tenancy, the presence of mutual aid networks, and the proximity to community services. These aren't replacements for traditional data points, but they are layers worth considering, especially when evaluating investor-owned portfolios over time. That brings us to a practical solution that really should be gaining traction: tenant education. Workshops that teach tenants how to identify hazards early, help maintain homes, and feel ownership of their space have strong potential to reduce claims and turnover. While formal insurance-backed pilots haven't quite caught on, early local efforts by nonprofit housing agencies have reported positive trends in unit condition and resident engagement. It's an area where testing and collaboration with property stakeholders could yield real, scalable insights. And imagine if renters stayed longer because they felt like it was their home and treated it that way. Now, let's take a look at how landlords can really lean into this opportunity.
Today, I've been out talking to landlords and tenants about what they need to continue to build trust and community. The phrase I keep hearing is tenants want to create homes, and looking to our European landlords may be the example we need. Common European practices like offering minor customization options for tenants, choosing paint colors or light fixtures, they're the simple acts that can signal trust in tenants. And in return, landlords benefit from better upkeep and fewer costly turnovers because tenants are able to create homes they love. And on a broader scale, communal infrastructure investments such as shared green spaces, maintenance co-ops, or neighborhood improvement grants could be recognized for what they are: stabilizers. They reduce exposure and increase tenant satisfaction. It's time we stop thinking of neighborhoods as static risk zones and start thinking of them as ecosystems. The better the ecosystem, the lower the long-term risk. In the end, Underwriting social cohesion isn't charity, it's strategy, and it might just be the competitive advantage insurers didn't know they were overlooking.
And with that, we bring this segment to a close, leaving you with a vision of how housing resilience can shape the future of our industry. Housing affordability is not just a social issue. It's a core risk factor that directly impacts insurers, investors, and communities. When housing becomes unstable, it's not just families who are displaced, it's our risk models, our loss ratios, and the stability of entire portfolios that shift with them. This is a measurable, insurable risk, every bit as urgent as climate change or cyber threats, and it demands innovation, focus, and commitment. We've shown today that solutions are within reach. Community risk pools, public-private partnerships, underwriting models that reward social infrastructure, and innovative triggers that respond to real-world conditions. These shouldn't just be theoretical ideas. They need to be used as the tools they are to strengthen portfolios while keeping communities intact. This is a moment for our industry to step forward. By piloting these approaches, collecting evidence from our own portfolios, and refining our models based on results, we can make resilience and stability part of the way we define and price risks. The insurers who act now won't just adapt to a changing market. They'll help shape a future where housing security and risk stability go hand in hand. Because at the end of the day, stronger communities means stronger portfolios. And in this business, that's not just good policy, it's good business. Thank you.